What is this chart saying? It's also saying we need a major decline because we haven't finished the bear market pattern, the wave C pattern. Someone said, and it's a reasonable question, the previous fourth wave on the constant dollar chart isn't that much lower than wave A. If wave C comes down, it should bottom somewhere in this range of the triangle, which is the lowest point being the 1932 low, and of course the apex being 1949. There is easily a way that the nominal Dow Jones Industrial Average can fall from somewhere near 3,000 down to below or down near 300 or lower, and have the constant dollar chart fall only to this area. And that is if we go into a severe across-the-board deflation so that the prices of commodities are falling almost as fast as the prices of stocks. Because that's what this chart is. It's a ratio of stock values to commodity values. So this chart I fully expect to show declining prices at a much slower rate because commodities should be falling also. The last time this happened was 1929 to 1933. Now I think a reasonable question might be, where is the next or the current major bear market likely to bottom? You may have noticed that I haven't been doing a whole lot of television lately. That's because I don't want to answer this question. If we've had 5 waves up from the late 1700s right into a high here in the 1980s, how much risk does this market hold? You already know what the likelihood is, what the probability is. Where should the correction eventually find its lowest price point? The answer is somewhere in the area of the 4th wave of the preceding 5-wave movement of the same degree. And of course that is in this range. The low is 41 and the high is about 380. That's a long way down. Now, I'm not here to predict that the market is going to do this, but I am here to point out that Elliott observed that when a 5-wave sequence of any size and duration ended according to his rules and guidelines, as long as all were followed faithfully, that the place that the ensuing bear market usually found its low was somewhere in that area. That's all we can say. However, that is a likelihood that in my opinion is so great that it is at least worth preparing for in terms of making sure you are not leveraged in the other direction. Okay, let's take a look at another market. We've been looking at stocks so far this morning. I'd like to take a look at a chart of gold. We're not looking at gold only because it's a different market, but because it's a commodity. And commodities have one difference in their normal wave development from that of the stock market. First, let's walk through the 5-wave structure, and I'll get to the difference as we approach the end of it. Back here in the late 1960s, of course, the price of gold was fixed. Nevertheless, it had an initial run-up to about $42 an ounce, came back in 1970 to match the previous low in a wave 1 and 2. Pessimism should match, of course, this period in terms of the ability of the price of gold to go up. And sure enough, in 1970, at least 2 economists were quoted widely as saying, as soon as the price controls on gold are removed, it's not going to go up. It's going to go down to $6 an ounce. Why? Because gold has no industrial value. And of course, it's an anachronism as far as money goes. Well, that set the stage for a good 3rd wave. And gold exploded right into this peak in 1974. In March of 1974, it hit $180 an ounce, exceeding even the wildest expectations of the gold bugs who got on the bandwagon early and said, you want to own gold, it's going to go up. Then came wave 4, Notice the alternation. This is a sharp movement against the trend. Wave 4 is different. It took that sideways shape, which included a new high. This new high, by the way, occurred on the last day of the year of 1974, when gold was legalized in terms of ownership by Americans. A classic case of people buying in anticipation of further buying and marking the exact top by doing so. Gold then collapsed 50%. That was a surprising disappointment to the gold bugs, particularly following the legalization of gold in the United States. In fact, one prominent gold bug committed suicide right about here, so I would assume that he was quite disappointed at the time. Actually, it was very unfortunate. He was a terrific analyst, and I wish you were around today. Straightened me out on some markets. In any case, once wave 4 was over, the fifth wave began, and this, as is typical with commodities, was the longest and strongest impulse wave in the sequence. That's the difference between commodities and stocks on the major trend when the major trend is up. Let me clarify that. The five-wave structure, the tendencies in the five-wave structure in terms of wave 3 generally being longer holds true even in commodities on the smaller degree trends and even on major trends in parts of corrections which are heading downward. But when the trend is up and it's a major trending market, usually it is the fifth wave which puts on the best performance. Well, is there a reason for this? After all, what we're studying here is social psychology, mass psychology. And I think the answer is yes. You see, when the stock market is creating its fifth wave, it's moving up on an emotion called hope. People are hoping things will get better, and they're willing to put more money into that market and say, around the corner things are going to be better, prices will be higher, I'm going to take a shot at this. Hope takes a while to develop and a while to dissipate. That's why fifth waves tend not to be as powerful as the third wave in the stock market. And it is also why tops often take a bit of time, if not clearly obvious on the price chart, at least obvious in terms of the technical development of the advances and declines and so forth. Commodities are different. The fifth wave in a commodity is not propelled by hope, it's propelled by a different emotion called fear. When gold is roaring upward in this fifth wave, it's not because people are hoping the future is going to be better. Of course, there are a few guys out there hoping it'll be worse. But for the most part, it is being bought by people who are fearful. They're afraid of inflation. They're afraid of what the government's going to do in reaction to it. They're afraid of the financial situation in general, and they're buying gold to protect themselves. When wheat is moving up very powerfully in a fifth wave, it is not because of hope about the future, it's because of fear. Fear of crop failure, fear of drought, you name it. That's why commodities generally have a strong fifth wave. Now, let's examine this chart to help decide where the bear market, which started in January of 1980, is likely to bottom. Notice I say likely. It's not guaranteed, but until proved otherwise by a clear five-wave structure to the upside indicating an impulse wave, I say it's best to withhold buying until the ultimate downside target area by the fourth wave guideline is reached. Well, the span of the previous fourth wave in this five-wave sequence is here, between $197.50 an ounce and $103.50 an ounce. That's a long way down, but that is where the wave principle suggests that the ultimate bear market low in gold will occur, somewhere in that range. And if the guideline is to be taken as it usually develops, probably nearer the lower end than the upper end. Well, this bear market, in my opinion, is still developing. The real deflationary period, as suggested by declining stock prices and declining gold prices, if we're right on these two charts, lies ahead. It is quite possible, because bear market patterns or corrective patterns often have very strong rallies within them, that gold could see higher prices on a short-term basis. But I still think that the best interpretation is that all of this is part of a much larger bear market or corrective pattern structure. In all of the examples I've used so far, and in the examples you're going to see for the rest of today and tomorrow, none of the rules are broken. What should you do as an Elliott wave analyst who is keeping real-time track of a market if a rule does appear to be broken? Well, there are only 3, so this is pretty easy to deal with. If wave 2, what you're counting as wave 2, makes a new low, it's not wave 2. It's something that's part of the preceding corrective pattern. The only other 2 rules are that wave 3 should not be the shortest and that wave 4 should not overlap wave 1. Now, just for convenience, I drew a chart, a developing price pattern, which would suggest that both of these rules have been broken. And I can't tell you the number of times I have seen analysts in print or otherwise say, well, look, this is clearly 5 up, even though there's overlap and a third's too short, you got to sell this market short. But all they're doing is selling themselves and their accounts and the wave principle short, because the wave principle says this is not a 5-wave structure according to the rules and guidelines of the wave principle. What should you do when you see this kind of development? How should you think? If you have taken a very close look at the wave structures and the real-time charts that we've been looking at so far, you will see that in almost every case, the resolution of this kind of early beginning is the same. Don't label this first wave, second wave, third wave, fourth wave, because wave 4 has overlapped wave 1. That 4 is not allowed. Even if wave 4 had not overlapped wave 1, suppose wave 5 were developing, at what point could you not label that wave 4 and 5 anymore? As soon as wave 5 is longer than 3, because wave 1 is already longer than 3, and that will make wave 3 the shortest. That count is wrong then on 2 major points. What is happening in almost every case is that in truth, this is a developing third wave extension. Remember, third waves are usually the longest in a sequence. Therefore, they tend to subdivide 1, 2, 3, 4, 5 very clearly before they are over. And the ultimate correct labeling turns out to be that. In other words, someone had labeled this 1, 2, 3, 4, and they were trying to get a 5 out of here, already having broken one rule when wave 4 overlapped, and then another rule when wave 5 got too long. What is the practical result of breaking those rules, of putting one's opinion before the wave structure? Well, what's this guy doing right here? He's selling short. He thinks the market's going to go down and correct from here. What is it actually setting up to do? Right in here, there's probably a 2-day pullback that convinces him the high is in, but actually the market is right on the threshold of the third wave, the most powerful upward section of this entire advance. Just when he should be the most bullish, he's turning bearish because he got lazy or dishonest and didn't follow the rules. There are only 3 of them. They're easy to follow if you keep them in mind. So the right thing to do is label this as a smaller 1 and 2 of a developing third wave extension pattern. That one little picture should keep you out of trouble of mislabeling waves virtually all the time. Now, for our upcoming exercise in wave counting, we must be sure to understand the primary concept of the wave principle. The one major discovery that R.N. Elliott made that changed the way people will be looking at stock charts forever. And that is that the market moves in 5 waves, according to the rules and guidelines we've discussed, when moving in the direction of the 1 larger degree, and in 3 waves, or some corrective pattern, which is based on the 3-wave theme, when moving against the trend of 1 larger degree. If this is a large 5-wave upward structure, then this wave, wave 1, is moving in the direction of the 1 larger trend and therefore subdivides into 5 waves. This movement, which is wave 2, is moving against the trend and therefore it will subdivide into 3 waves. This holds true right up through wave 3, 5 waves, 3 waves on the pullback, 5 waves up. Now, you see right here, for instance, a wave 4 taking the 3-wave shape. This is a blow-up of that correction. My question to you is, if this is an ABC correction, which is moving downward right here, how many waves should wave A subdivide into? Sometimes I hear 5 and sometimes I hear 3. At least nobody said 4. The answer is wave A subdivides into 5 waves. The reason is that wave A is moving in the direction of the 1 larger trend. This 1 larger trend's direction is down. The correction is a counter-trend movement. We were talking about a bull market, therefore the counter-trend movement is down. Wave A is moving in the direction of the 1 larger trend, which is also down. It will subdivide into 5 waves. It is incorrect to express the wave principle as 5 waves up and 3 waves down, because the direction per se doesn't matter. What matters is what the direction of the 1 larger trend is. Then the movements of 1 smaller degree will subdivide into 5 waves when moving in that direction and 3 against. How many waves should wave B subdivide into? This now, you see, is the counter-trend movement. Wave B is the correction of a declining sequence. Wave B is moving against the trend. So it subdivides into 3 waves, or some kind of corrective pattern which is based on the 3-wave theme. Wave C, of course, is moving in the direction of the 1 larger trend, which is down, and therefore will subdivide into 5 waves. That one concept is going to keep you in tune with markets when you open a chart book and say which direction are the 5s moving in and which direction are the 3s moving in. That in itself will give you a lot of information. Another reason I brought this up now is that we're going to come back and we're going to walk through the wave structure of a bear market. So you have to understand how the wave structure will develop in the downward direction, which is exactly the same as the way it develops in the upward direction. Let's take one glance at a bear market picture, which we all know and love. That of U.S. Treasury bonds from the 1940s. Well, this market traced out 5 downward waves from the 1940s right into the 1981 low in bond prices, which of course was the high in interest rates, since they're the inversion of each other. Well, let's take a look at some of these things. Is wave 3 the longest? Yes. Wave 1 is rather short. Wave 5 is certainly much shorter than wave 3. Let's take a look at where a counter-trend movement would likely end if we've had 5 waves down. Well, where should it end? We're having a correction now, but in this case it's pointing up instead of down. The guideline still holds. It should end in the area of the 4th wave of the preceding impulse, which is why this little 4th wave area, in my opinion, for the past several years, has stood as resistance to this corrective counter-trend rally. The long bond in approximately